If you've been turned down for a rental property loan because your debt-to-income ratio looked too high on paper, even though the property itself cash flows just fine, you were probably applying for the wrong type of loan. There's a loan product that doesn't look at your personal income at all. It looks at whether the property pays for itself. It's called a DSCR loan, debt service coverage ratio, and once investors understand how lenders actually calculate it, they stop getting rejected for the wrong reasons. Here's the formula lenders use, and it's simpler than people expect. Take the property's gross rental income, divide it by the total debt service, meaning principal, interest, taxes, insurance, and if applicable, HOA dues all in. That ratio is your DSCR. A ratio of 1.0 means the property's rent exactly covers its debt payments with nothing left over. A ratio of 1.25 means the rent covers the debt payments with 25% to spare. Most DSCR lenders want to see 1.0 to 1.25 as a minimum, and the better your ratio, the better your rate, and the more leverage you can get. Here's what trips people up. Lenders don't just take your word for the rent. They order what's called a 1007 rent schedule from the appraiser, which is the appraiser's independent estimate of market rent for that property based on comparable rentals in the area. If you're already leased and the tenant is paying above market rent, the lender typically uses whichever number is lower, either your actual lease or the appraiser's market estimate. This catches investors who bought in a hot rental market and priced their lease aggressively, only to find their DSCR calculation on refinance uses a lower, more conservative number. Property type changes the math too. On a single-family rental, you get one rent number from the 1007. On a 2 to 4 unit property, lenders total the market rent across all units, which is one reason small multifamily properties often qualify more easily for DSCR financing than single-family homes of similar value, because you're stacking multiple income streams against one loan. Now let's talk about the trade-off, because DSCR loans aren't free money. Because you're not verifying personal income, tax returns, W-2s, or employment, these are considered non-QM loans, non-qualified mortgage, and they carry rates typically half a point to a point and a half higher than a conventional investment property loan. Down payment requirements are usually steeper too, commonly 20 to 25%, sometimes 25 to 30% if your DSCR ratio is under 1.0, meaning the property doesn't fully cover its own debt, and the lender is taking on more risk. Here's the clause that catches new investors off guard, the prepayment penalty. Most DSCR loans carry one, often structured as a declining percentage over 3 to 5 years, sometimes called a 5-4-3-2-1 or a 3-2-1 structure. That means if you sell or refinance in year 1, you might owe 5% of the loan balance as a penalty. Some lenders offer a version with no prepayment penalty, but you'll pay a higher rate for it. If you're planning to hold long-term, taking the penalty in exchange for a lower rate usually makes sense. If there's any chance you refinance or sell within 3 years, negotiate the prepayment structure before you lock the loan, not after. Let's talk about what actually moves your DSCR ratio, because this is where investors have real control. Property taxes and insurance are baked into the denominator, so a property in a high-tax county or a high-risk flood or wind zone can tank your ratio, even if the purchase price and rent look great on paper. Before you go under contract, pull the actual tax bill, not the seller's current bill if there's a homestead exemption that won't transfer, and get a real insurance quote, not an estimate. I've seen deals die in underwriting because the buyer assumed the seller's low tax bill would carry over, and it didn't, because the county reassesses on transfer of ownership in a lot of jurisdictions. Also worth knowing, some DSCR lenders will let you use projected rent on a value-add property, meaning if you're planning renovations that justify a higher rent, they'll underwrite to the post-renovation number rather than the current one, as long as you can support it with comparable rents. This is a completely different conversation than a conventional lender will have with you, and it's one of the reasons investors doing BRRR-style deals lean heavily on DSCR financing for the refinance step. If you own more than a handful of rentals, ask about blanket or portfolio DSCR loans, which wrap several properties under one loan with one payment instead of separate financing for each. The advantage is simplified underwriting and often a better blended rate than financing each property one at a time. But the trade-off is cross-collateralization, meaning all the properties in the blanket loan secure the entire debt. If one property in the portfolio has an issue, a fire, a lawsuit, a tenant problem, it can affect your ability to release or refinance the others until it's resolved. Read the release clause carefully, meaning the terms under which you can sell one property out of the blanket loan without disturbing the rest. Short-term rentals get their own version of DSCR underwriting, and it's worth knowing because the income calculation is completely different. Instead of a 1007 long-term rent schedule, lenders typically use a short-term rental income report, often pulled from a data provider like AirDNA. That estimates annual gross revenue based on comparable short-term rental performance in that specific market. This can actually work in your favor in strong vacation rental markets, since the projected revenue often comes in well above what the same property would rent for long-term, improving your DSCR ratio and your borrowing power. But it also means your loan is underwritten against a number that assumes consistent occupancy. So if local short-term rental regulations tighten after you close, your actual performance can fall short of what got you approved. In markets like Tampa and St. Pete, regulations can vary by county. Make sure you understand the local compliance rules before relying on STR income. And in Florida, that insurance number in your denominator is real. Wind and flood coverage can make or break your ratio, so get those quotes early. Even though we aren't verifying your income, your credit score is still a primary driver of your interest rate. Most lenders have a strict floor, usually around 660, and your rate drops significantly once you cross the 720 or 740 mark. New construction properties in Pasco and Polk counties often have an underwriting advantage. Because the property is new, maintenance and capex estimates are lower, which keeps your denominator cleaner and your ratio higher. Additionally, insurance premiums are typically lower for new builds with modern wind mitigation features, further improving your DSCR and making the deal easier to qualify for than an older rental, even if the lender doesn't require it. Smart investors always factor in a 5 to 10% maintenance and capex reserve. If your lender sees you have these reserves set aside, it strengthens your overall profile during the underwriting process. Tampa is a global market. DSCR loans are an incredible tool for foreign national investors who don't have US-based income or tax returns. As long as the property itself cash flows, we can often secure competitive financing for international buyers. With the massive population inflow into Central Florida, the demand for high-quality rental housing is at an all-time high. This durability is exactly what DSCR lenders are looking for in a stable investment market. Diverse renter profiles from medical staff at USF to military families at MacDill, and growing logistics hubs ensure long-term stability for your investment portfolio. The key is focusing on durable markets with population growth. DSCR loans are the tool that lets you scale your portfolio without hitting the personal debt limits that stop most residential investors. One more thing that matters. DSCR loans typically close in an LLC, not your personal name, for liability and professional separation, which has implications for both liability protection and for what insurance and financing terms you'll be offered down the line. Confirm with your lender early whether they require personal guarantees on the LLC loan. Most do, so while the asset is in an LLC, you are still personally responsible for the debt performance. So the liability protection benefit is about lawsuits and tenant claims, not about the lender's ability to come after you personally if you default. So here's your actionable takeaway. Before you shop for a DSCR loan, run your own numbers first. Pull actual tax records, get a real insurance quote, and calculate your ratio using conservative rent, not your optimistic number. If you're under 1.0, know that you'll need a bigger down payment or a lower purchase price to make the deal work, not a lender willing to bend the rules. And always ask about the prepayment penalty structure before you lock, because that clause will cost you more than the rate difference if your hold period doesn't match the loan. Whether you're looking at new construction in Pasco or workforce housing in Pinellas, having the right financing structure is half the battle in this Florida market. I'm Tony Damiano from eXp Realty. If you're looking to navigate the Florida market, reach out to me at 813-345-7487 or email tonino.damiano@exprealty.com. Let's get your next deal done.